Ever wonder why banks keep offering you credit cards? No annual fee, cashback, rewards, high limits. Sounds great, right? But here's the truth. They're not giving you that because they like you. They give you all that because, on average, they make way more money off you than you make off them. And today, I'm gonna show you exactly how they profit from you. And more importantly, how to flip the game. By the end of this video, you'll know how to use your credit card to build wealth, not lose it. Because in the credit game, if you don't know the rules, you're the prize. Let's fix that. Well, don't forget to subscribe to be part of our community. That's it. Let's dive in. So first part, how banks really make money on you. Ever wonder why banks are practically begging you to get a credit card? You're in an airport. There's a booth. Buying a snack, they offer you one on the card machine. Open your banking app. Boom, pre-approved limit just for you. It feels like a gift, but it's not. Let's get into the numbers. In 2023, U.S. banks collected $157 billion in credit card interest and fees, according to data from the FDIC analyzed by Financial Times. Not from investments, not from managing wealth, from people like us swiping plastic. And most of it, the bulk, came from interest payments. The rest, fees. Late fees, cash advance fees, foreign transaction fees, annual fees. They've built a business model where your mistakes, they're profits. But this isn't just about the money. This is about how the game is built. Credit cards weren't invented to set you free. They were designed in the 1950s to do one thing: extend consumption, to make people spend more and feel good about it. And banks figured out something early that you probably never heard spelled out like this. People would rather feel rewarded than avoid pain. That's why you get points, miles, cashback. Because while you feel like you're winning, they know the average person is slipping. And when you slip, that's when the real money rolls in. Now here's the psychological trap. You feel less pain spending with a credit card than with cash or debit. This has been studied at MIT. It's real. It's called the pain of paying. Swiping a card numbs your brain to the cost. And banks are counting on that. That's why they give you a limit higher than you need. That's why the minimum payment exists. So you think you're doing fine when really you're feeding the machine. I've been there. I used to pay the minimum. I thought I was being responsible. I was earning some miles, getting little perks, and that's when it hit me. The credit card isn't dangerous because it exists. It's dangerous when you don't know what it is. It's not a perk, it's a product. And when the product is free, you are the product. But that changes the moment you understand the rules. Because yes, you can flip the game. You can use credit, like the wealthy do, to build leverage, not debt. To earn rewards without paying a cent in interest. To play offense, not defense. And that's exactly what we're going to break down next. Now moving to the second part, let's talk about two cool tricks. See the video of this guy.
He said, "You can't buy the Royal Trust building on a credit card." I said, "You're kidding me?" I had written one building, 65 million, I'd signed it. Yeah. I said, "Could you please call for an authorization?" And it was a gold Royal Trust credit card. They sent me my bill yesterday, and I paid it, and I brought it up to date. That means I won't get another bill for 30 days. That's worth 1%. 1% is $650,000. And I said, and by the way, I don't know whether you know it or not, but on a gold Royal Trust credit card, you get a 1% discount. That's 1.3 million. You guys took 5 million out of my pocket. I'm taking 1.3 out of yours.
This man bought an entire building with $65 million in a credit card. This shows how wealth people just play the game differently. In fact, I already have a video on my channel explaining why I financed my $1 million house even though I had that money in cash. And I know this video has already completely changed your way of thinking, but let me show you some really good and functional tricks. Besides taking advantage of the cashback, of course, because you just learned that. The first trick is how installments can protect you from inflation. Think about the iPhone 16 from the Apple Store. The retail price is $999.99, and there's this payment option, $0 down, $0 a month over 36 months with select carrier deals, 0% APR. At first glance, putting nothing down for 3 years seems like a scary commitment, but there's a financial twist. Inflation can actually work in your favor here. Here's why. Current U.S. inflation is around 2.4% annually. With 0% APR financing, you're effectively borrowing money that's slowly losing value. Let's break it down. That monthly payment is about $27.78,999.96. If inflation stays at 2.4% per year, the real value of your final $27.78 payment in today's dollars is around $25.80. You're still paying $27.78 nominally, but the real purchasing power of that dollar shrinks over time, and the earlier payments are worth slightly more than the later ones. So across the entire 36 months, your effective cost is lower in real terms. That means you keep your $999. You repay over time with cheaper dollars as inflation erodes their value. You're not paying interest. You're letting inflation chip away at the real cost. So when financing is interest-free and inflation is positive, you're subtly winning. You're getting the same device, but effectively paying less in real terms, as long as you don't miss a payment. And going further, if you keep your money invested, even with a low return like 5%, you are still beating inflation and earning extra money. It's one of those rare cases where inflation works for you, not against you. Well, now trick number 2. You ever see those offers? Spend $4,000 in 3 months and get $750 in points. Most people ignore it. Or worse, they fall for it and spend money they didn't need to spend. But here's the move. You take a card with a big bonus. Let's say Chase Sapphire Preferred. 60,000 points after 4K spent. But instead of spending recklessly, you just redirect your normal monthly expenses to the card. Rent, using a payment service, goes on the card. Groceries, card. Phone, internet, gas, all on the card. You hit the spending requirement without buying anything extra. Meanwhile, your actual cash, the $4,000 you would have used, just sits in a high-yield savings account earning 5%. That's called using the float, the 30 to 45 days before the bill is due. At the end of the month, you pay the card in full. You pay 0 interest. You pocket the $750 bonus, and you still earned a bit of interest while your money was sitting. Do this 3 times a year. That's $2,000 plus in clean, tax-free value. And the banks, they make nothing off you. You didn't pay interest. You didn't carry a balance. You just played the game better than they expected. But just a disclaimer, this only works if you pay your card in full every month. If you carry a balance or miss a payment, the interest kills the bonus, and the banks win again. So don't play this game unless you're disciplined. If you are not disciplined, you have already lost, as I explained in the first part. This is how people with real financial strategy use credit. Not to get by, but to get ahead. That's it, cousins. Stay invested.